Bull markets are born on pessimism, grow on skepticism, mature on optimism, and die in euphoria. John Templeton, one of the greatest investment quotes of all time, is starting to become more and more real in this market. With Nvidia now becoming the biggest stock in the world and what looks like euphoria starting to appear in the markets, are we actually heading for a soft landing, and can we avoid the inevitable crash that might be on the horizon? Well, today we discuss all of that and the likelihoods together, along with the short-term time frame hits of some of the biggest levels we've seen in some time. With trillions of dollars of options on the line, we've just reached 20,000 on the NASDAQ, 5,500 on the S&P 500, and of course key levels on many other markets around the world, including Bitcoin. But what might actually be the most interesting is some of the markets around the world that not that many people are talking about. Today, we've got breakouts and we've got some amazing macro data. Join us as we go through stocks, commodities, and cryptos together right now. So welcome back everyone to The Daily Show. My name's Tom, and as always, we're going through the latest macro data and of course the leading indicators that you need to be watching. If it's your first time here and you want to learn more about money flow and where Wall Street's biggest positions are, remember to subscribe and smash that like button. So let's begin today's video by discussing this great chart here from Jason Gottfried, and basically it goes through whether we're seeing a soft landing narrative kind of playing out right now, and of course whether we're actually seeing a short-term peak. As we hit big key levels such as 5,500 and 20,000, we have to ask ourselves whether these psychological levels really matter. Well, as it turns out, while June doesn't tend to actually have a peak in the market, July certainly does. In fact, 24% of the time, we see a 1 month peak in July and a 3 month peak 12% of the time, making it the most peaky month of the year. And one of the reasons why this tends to happen is, of course, we do usually see weakness in this period during election seasons. So somewhere in that August, September, October, we tend to have kind of like a topping market that sometimes sees a minor pullback, maybe even something a little bit bigger. But what about the soft landing analog? This is something that everyone's been discussing. The idea that the markets are climbing the wall of worry, we're possibly going to see a soft landing. And as you saw at today's start of the video, it looks like articles are being written that way. Oh yeah, we can fall 40%. We'll do it in a leisurely manner and it will be okay. I'm here to tell you one thing. If we are working into the world of bubbles, which we are probably at this stage, and we have thought this for quite some time, generally they go further. Secondly, they tend not to crash when you're in the word bubble. And third thing is they always crash. There's usually no way around it. And generally speaking, a soft landing narrative is usually not going to work out. You can see here, based on other analogs over time, we've had a couple that have actually followed all of the same path. In fact, we're tracking the same way that we would have been in 2016, in 1998, in 1994, and 1966. And it turns out that this market is actually right on track, with something possibly going to happen more than likely somewhere between that 2025 and maybe even 2026 level. Now, a lot of these did not end well. I mean, you remember that, of course, the 1998 one, well, that ended up in the dot-com boom. And as we've launched many, many times, the 60s one, which is very similar to right now as well, a concentrated market, well, that didn't end very well either. So with both of these two most likely scenarios coming through, what do we have to do as investors and traders? Well, I think we have to be aware of the situation. This is the chart pretty much here from Grant Hawkridge that basically shows what most people are worried about. A concentrated market with less stocks going up than ever before. In fact, we've got them basically going down across the board, and really the biggest stocks starting to drive this market completely. Now, is this unlikely? Is this not usually going to happen? Well, sometimes when you go into leadership, the rest of the market ends up playing catch up. And of course, that's what a lot of the bull narratives are right now. We're going to play catch up. We're going to see this improvement. But here's a quick chart from the equal weighted market. And what it shows you is that 44% of stocks in the S&P 500 are now actually only above their 50-day moving average. That means that over 50% of the market is now below its 50-day moving average, and that's pretty unusual. We don't tend to see that often, and of course it's got a lot of people worried. What about the environment list? Are we still seeing an overall bullish thrust? Well, yes, the price action is ultimately the most important, and it doesn't matter how many macro charts you throw at it. Ultimately, if you're making a series of higher highs and higher lows, as we are right now, you generally want to be bullish in markets. And of course, that's what we've been seeing now for most of 2024. But as we've pointed out, there are some points to be a little worried about. And as we'll bring it up in the charts later on, from at least a short-term high, we really could be seeing that happening in front of our eyes. Dark pool activity in particular that we'll show later on, plus these key psychological levels, could have us seeing a little bit of a top here, either through June into July, most likely July, and then seeing that little bit of a pullback that gives people opportunities to get back into this, at this moment, bull market. So let's take a look at 2024 and Wall Street's big forecast for what they expect the year end to be. Now, I would expect a lot of upgrades to come across the board, but as you can see right now, we're trading around 5,500, yet everybody thinks that the market should be trading at around, let's say, 4,900 to 5,000 on average. Now, firstly, you'll find that most of these upgrades and most of these levels are completely out of date. Secondly, you'll also find that they usually get it wrong. I mean, look at JP Morgan over here. On one hand, they're saying, oh, the crash is going to come. Then on the other hand, they're buying the market out of control and also lending out of control. So this is really a chart showing you that, yes, these can affect the market in terms of positively or negatively across the board if all of them upgrade or all of them downgrade across the board. But realistically, you have to take it with a grain of salt. Let's move over to the narrative as well that Fed cuts are coming. How are we going to see that? Check out our last video that has a lot of information about what we expect to see if Fed cuts really are going to come. But one of the things, just a quick reminder here, is that we should start to see bonds perform particularly well. And I would like to see if cuts are really going to come through, you're going to see things like treasuries really perform nicely. And we might look at a chart on treasuries a little bit later in today's video so you can see what I mean and what we will be looking for. Another reminder is we're posting our US 500 charts with all of the key levels and a little bit of thought process into them over on X as well. So links in the description if you want to follow us there. But I want to talk about an opportunity. We've discussed this a few times, and we've discussed the idea that, yes, okay, the US is the best market in the world, but there are other markets out there that actually seem to be having some pretty good technical runs. Now, one of those has, of course, been the Chinese stocks coming out of the rut and basically starting to climb the wall of worry. Now, recently that became a little bit of a flurry and the market had to have a pullback, and of course it did. But guess what? We're starting to see short interest continue to the upside. And it's actually now getting into a point here from macro charts that it's almost at the highest point again than we've seen in years. And this usually is correlated with pretty strong moves in the markets. You'll notice here short interest gets massively high. What happens? The markets go up. Short interest gets massively high. The markets squeeze that out. So you might assume that all these hedge funds are correct. But if you know your stats about hedge funds, then you would know that a lot of them actually underperform the market and get destroyed. Here's the most recent chart from the traders betting on short interest in China large caps. And you'll notice it's not exactly going down. It's in fact managed to really scale up here into May. And I've got some good authority that it's actually continued to scale up into June. So while the markets are coming down, it looks like we've got these fairly decent rallies starting to come up in the price action. We'll look at that chart very, very soon because remember, there are always opportunities out there. So for the long-term holder, do you need to be concerned about this run? As we saw, John Templeton's quote basically again says, markets are born in pessimism, grow in skepticism, mature on optimism, and die in euphoria. So I actually asked a few of you guys over on X, and you said, some of you said euphoria, but a lot of you were saying skepticism in the later stage. And it seems like across the board, most people think skepticism and optimism seems to be where you're at. Now, I would tend to agree with this because remember the word bubble, which we've been looking for in the articles, and guess what? It's right here, right now, thanks to Nvidia making it to the biggest stock in the world, has now come across all newspaper articles I can think of. All mass media outlets are talking about the word bubble. Now, that usually means that you are in the final stages. Basically, you're in that point where I would say we're kind of in some form of the optimism stage, and we're moving out of skepticism into optimism, and then, of course, we'll go into euphoria. Now, you might think, well, we're in euphoria right now. As we will show on this show in a few more months and over the next couple of months, so make sure to subscribe, we will look at comparison ratios between Nvidia, between Broadcom, between the general market, and previous bubbles, because although none of them are the same, and we all know that, what you tend to see is a lot more in terms of runs. And if any of you have ever studied Japan in the 80s and the 90s, you would know that that was the mother of all bubbles. Now, I'm not saying we're going back to that point. Let's hope we don't, because if we do enter those types of bubbles, you end up seeing a lost decade plus, maybe even 20 years of lost returns, and the S&P 500 would not be the same over the future if it did crash off that. So we need to come back to kind of reality. Where are we? Well, we're in June of 2024, and as you can see here on this cyclical bull market chart, it shows you the median duration tends to be longer, 31 to 33 months. Now, I think this is a fair pick, considering we also see soft landing narratives at least push us through to 2025 at this stage. And what it's showing is that if we do see peaks, then we need to be looking for turnarounds on the smaller timeframes. And this has actually helped to see quite a few of the little pullbacks that we've had so far. And remember, you usually get 2 per year that are fairly large. So that's between that kind of 5 and 10%. Generally per year, you get 2 of those. So we might be heading into a little bit of overvaluation of the market right now, maybe a bit of skepticism, markets fall through, and then hopefully pick up a little bit later on. So we'd like to see maybe a topping anywhere from now into July. That would make sense, at least based on the stats. Short term, of course, in this case. US bond valuations, well, their bond model here from Jury and Timmer is pretty cool. Basically, it just shows you what is expected based on all of the information we've got right now. That is the Fed dot plot, the GDP numbers, what everyone's kind of expecting in terms of the market. And what it's showing you is that they expect a gradual decline in yields, and most people are now starting to price in cuts kind of across the board. But I could see this actually sitting and like kind of leaving it there for quite some time. And remember, if the Fed do cut, it's probably more going to be a steady cut for now. If they cut 50 basis points, be terrified. 50 basis point cut out of nowhere. If they say cut 25 and then they cut 50 really quickly, absolutely be terrified. That is not good. The Fed will be basically signaling to the market, ooh, something bad's happening, and we know it's coming and we're going to have to do those cuts. Generally, the market will have sniffed it out first. Let's have a look at the dark pool activity to see whether a short-term high could be coming in. First up, I just want to quickly talk about Tesla. Of course, we discussed this in our last video. Some large activity here, which we saw, and then again, some nice kind of gap fills. And although Tesla was down about 1% in the last session, when we do open up after, of course, the US public or the US holiday, we'll basically see a market that is hopefully going to continue to see Tesla rally. We'll talk about the gamma, we'll talk about the options in just a couple of moments. What about the big dark pool activity? Well, we've seen a couple of points. We've had the 3x funds basically showing dark pool activity massively around this level. Now remember, this coincides with 5,500 and 20K on the NASDAQ. So I think it's profit taking by at least somebody, and that's because they're sitting on some profits coming into this week's $1 trillion option expiration, and that's going to be a big point. Now, in terms of options expirations, usually the Thursday is the more volatile of the days, which is, of course, we're about to open, and the Friday can sometimes be a nothing burger. We'll find out whether that is true, but another big dark pool transaction coming through late last week, I think into this week, and that is in semiconductor ETFs. Now, of course, they've been the hottest right now. I don't think that's probably a buy. It's probably at least some kind of profit taking, but it could tell us that there could be a little bit of a temporary high coming into these markets in what looks like a euphoric run through Broadcom and, of course, Nvidia. Complete guessing at this stage. You do not have any price action to go with it. All you've got is, of course, a little bit of dark pool activity, a couple of little bond indicators saying maybe a short-term highs here, and a stretched market by most instruments. And whenever you get to these levels, you've just got to be more cautious. And of course, we'll talk about those key levels in a moment. Let's go through the rotation. Where have people been buying? Where have they been selling? Well, gold had a little bit of a comeback, which was nice. Gold stock's doing okay. Home builders got beaten back down, giving up what they've really put on recently. And semiconductors continue to lead the market. Another one of interest was energy stocks, because energy stocks started to look quite nice when it comes to the open. And also US oil, of course, on the improvement, as we've discussed and will discuss again in today's video. It looks like basically sell-offs in oil might be being purchased up. And XLE in particular, if you look at it on a chart, has been beaten down quite a lot recently. From the growth perspective of the market, all the normal ones are there. Semiconductors, technology, consumer discretionary, And again, on 5 days, KRE still doing pretty well, which is regional banks finding those buy pressures. So it's not too bad in terms of what you actually see in terms of rotation in the markets. Let's now have a look at the elephant in the room. The advanced decline line still kind of overall going down, and of course some exhaustion techniques starting to show themselves on the S&P 500. In particular, I noticed that we're a little bit disconnected from the 20-day moving average, and again, a pull back down to some of the levels we'll talk about in a moment, such as 53.50, may be in order to get this market back into line and maybe start to see a little bit of rotation into the rest of the sectors. But this is the main chart, and you can see here the bulls were in control, at least going into that bank holiday. Now let's move over to what else has been happening on the futures market. And I've updated all these levels with the new option expirations. So basically we have 1 day expected options moves of 55.36 or 54.37. They're the bands where the market expects us to hold within. We are hitting the major call resistance, and we're starting to see extreme exhaustion on the daily charts. So really what this does is it brings up the question of, would you really want to buy around 5,500? You've got to put yourself in the shoes of what a trader would be looking at and what an investor would be looking at. People that purchased down here in April, well, they're on some pretty nice profits. If you manage to buy the low, you're on almost 11% out of the US 500, let alone the NASDAQ. And you're hitting the 20,000 on the NASDAQ as well, which we'll look at soon. So would it make sense to see some kind of weakness here? I think it would. And what I'd be looking at is smaller time frame weakness. Although the longer term investor's not really going to care about this. They're just going, okay, well, something like this could be one of my worst kind of case scenarios right now. And of course, the market is inherently very bullish. So if it does pull back, the levels that I expect based on all of the analysis would be 54.37 and 53.50 to find potential buyers. And I think both of those zones make a decent amount of sense when we look at the structure. So yeah, markets right into that exhaustion period. And as we can see here on the options market, it makes sense as well. 55.20 becoming the call resistance on the Thursday, and on the Friday, 5,500. So what if we saw like a little bit of an uptick, then a sell-off? Well, that would make sense. And you can see here, even on Friday, if these aren't all hedged off, because of course we are in a positive gamma situation, so technically the market is squeezing up as we keep going through all of these call levels and forcing the dealers to actually hedge against that, then this is something that's going to become quite an important zone. But we could also see, you can see here 54.25 being a little bit of a put zone for Friday, and also for around that kind of level for Thursday. So yeah, I would say that 5,500, 55.20 may act as a bit of a wall coming into these options expirations. Let's take a look at the longer term, the CTAs, the Commodity Trade Advisors. If you're new here, these are something that you might want to start considering to see whether they're actually buying or selling. They're remaining overall net bullish, neutral bullish, so that's not too bad. S&P's the same. And if we have a look at some of the commodities around the world, since oil's been picking up, they've picked up and they're hovering for now. I'm looking for a nice strong buy here from the CTAs in oil, so we'll see whether that comes in the next video. Make sure to stick around for that. And then of course we've got gold, which has been, I would say, neutral for now. What about some of the most important stocks? Well, Nvidia, of course, is the most important stock, and it just keeps driving up. Very positive gamma. I'm not going to fight against it. Yes, we know that semiconductors are getting very extreme in terms of they need a bit of a slowdown at some point now, but you don't fight, something that is absolutely running like a freight train. And with freight trains, you're either guessing or using a psychological level. Now, of course, we're reaching 140, which we know has a lot of calls on it. And the higher we go, if we go above 140, let's say Thursday, Friday, and it's not hedged off, of course, that will end up squeezing the stock higher. But really for now, Nvidia seems stuck between 135, 140. And again, there's a lot of calls here. So I don't think that Wall Street will want to push it above that zone. I'd say they're offside if it does get above 140 zone. Let's move over to Tesla. How's that trading? Well, much better. Of course, spot price trading at 185. We know 185 is a huge strike this week. Look at that. Huge, massive amount of options sitting on that. So 185 is huge. If we do manage to hold above 185, again, positive gamma situation. We're looking towards Tesla potentially starting to price probe that $200 again. And regardless of your opinion on Tesla, whether you think, oh, Tesla's worth 200, I don't even know what it's worth. No one really does at the moment. But if you think it's worth $200, $300, $99, the truth is that when you break out, if you are in a positive gamma situation and you keep pushing these levels, then it tends to create those kind of flow-on effects. So we've seen that happen with Nvidia. We've obviously seen that famously happen with the S&P 500 in 2024. Let's move over to some of the lead indicators. Then we'll look at some of the major commodities, and of course we'll finish up with indices and crypto. And we'll start off here with our bond indicator with options. And basically that jumped out the other day. Again, a little bit of a warning sign of maybe a temporary high coming in. If this jumps again, we're sitting around 5,500, and it jumps again, I would say that becomes more likely that it is a temporary high, and we're looking for shorter time frame, let's say price action towards the downside at that point. ITB, so this is home construction, I would say neutral at this point. Same with DJT, but DJT has been weakening. So a lot of people, DJT or Dow Jones Transportation Average used to be one of the most important charts. I would say right now, really, semiconductors is probably a more important chart. You can see here when you put that on it, it looks like a totally different story. So DJT may be losing relevance. What isn't losing relevance, though, in my opinion, is consumer discretionary versus staples, which is stabilized in recent weeks. And we've been talking about how Shop had a great run in it, how we started to see flows into XLY, and they've actually come through a little bit. So yeah, again, consumer discretionary improving against all odds, you would have to say, in this market, and against certainly some of these media articles that we're getting, kind of thrown at us at this stage. US dollar, much tougher to read. On the weekly, you would say it's bullish, but it hasn't broken through 105.50. On the smaller time frames, you'd say it's neutral, because we know this is where the sellers or the bears sit. So basically a very important level for the US dollar, and I look forward to looking at some breakouts here on this one, but either way. But yeah, at this stage we don't have that. What about copper? Well, it's stabilized. It's actually formed what we call a tweezer. So that's happening right at our watch reaction here level. Still too early to tell. Hasn't broken through 460 yet, which is kind of like our first alert that things are starting to improve. 470, obviously swing traders should start to buy up copper at that point. And this is certainly a bullish signal usually, but it didn't manage to hold too strong against it. So I would say still cautious on copper. Investors and position traders might be starting to get a little bit excited though, because that's the first sign of any type of strength that we've seen out of this market. What about gold? Well, it's barely climbing higher. We know how important the 2280 level is. We talked about this being the chance of the double top. If it does breach underneath, of course, we know that's very negative. I'm looking still for signs of gold going up. Now, if you've been watching the channel for a while, I've been a big gold bull this year, and it's actually been, I think, the second best major asset class of the year. However, I don't know whether gold is going to break out just yet. We haven't got really that evidence that you usually look for. And as we say, patience, react, don't predict tends to be the better move. I am making a bold prediction, I guess, in some ways, that we're going to get to 3K an ounce over the next 12 to 16 months. But that's not really based on, it's based on a lot of cyclical kind of concepts. So it's not necessarily based on just the price action itself. Of course, with the price action, we'd like to see it break around this 2380. And if it breaks below 2285 and doesn't instantly find buyers, I would say a great positional level could be down at 2165 at that point. So for now, yeah, cautiously neutral bullish, I would say, on gold. Let's move over to oil. So we liked this the other day after, of course, it rallied through this point, and I've now updated the chart. So I'm watching reaction for bulls at around 78.20. I'd actually like to see it return back here, hit the 20 moving average, which we know it's respected a hell of a lot recently. It's actually been an amazing moving average recently. This is the only false break we had. So I'd love to see, you can see even here it respected it. So I'd love to see it come back down to this zone. And you might say, but you're bullish on it? I am. But you can see here some exhaustion signs after that huge rally off the big position zone. So I'd like to see traders be able to get oil in at around this price. We'll see whether it pulls back enough. At the moment, it's looking kind of negative. Push down, bull back up, get to around 84 a barrel plus. Yeah, I hope that is what's going to happen with oil. And another reminder as well, if you actually look at XLE, which is, of course, the energy sector, it started to show signs. Look at this downward channel. What a beautiful downward channel, especially on the bottom end. And it's getting close to some serious levels I had alerted a while ago. So certainly watching energy stocks quite a lot at the moment. Tesla looks like it's broken to the upside. To me, that's an important sign. And of course, it was coiling for like 3-4 weeks. So a breakout to the upside would be really great. 200, interesting target zone. And for now, the price action is still in the favor of the bulls. With Nvidia, of course, driving higher, you want to look at all of the semiconductors. So semiconductors versus SPY is one of our favorite combos to look at. And that market's not showing any signs of weakness just yet, although it is starting to get a little extended away from its 20 moving average. And one of the things I found on Nvidia is I went through the history of it a little bit. And actually what I did was, this is basically mean reversion. If we have a look here, we're starting to move around, or to the upside's about 20%. But if we actually look from the bottom up, which will be more, of course, we're looking at about 40+%. Now, this tends to be between about 40 and 50% tends to be the topping of Nvidia in the past 3 major moves. So we are certainly getting up there. And what I mean by topping is it's before it consolidates or has a pullback. So right where it is right now is starting to get incredibly extended. And I guess I just wanted to mention that because, yeah, I don't know if it's an excellent level to buy in right here. NASDAQ, 20,000, big psychological level. Again, a lot of exhaustion techniques starting to come through on these charts, and they're all happening at that psychological level, which is the main key. US 30 still struggling, not a great sign for the broader market. If it does break through 39.20, 200, make sure you've got your alerts on that because that will be important. And of course, the US 2K, it's floundering. It doesn't really look great, doesn't really look terrible, I guess. Although it has been weakening recently. I'm looking at 2100 breakout for a massive momentum shift. But for now, anywhere in here is kind of where the bulls may be sitting. No really good price action just there. So which market becomes the most interesting at this point? Well, I think it has to be HSI. And when you in terms of major indices. And this is something we've been watching for quite some time on the channel. And we've, of course, been rallying it throughout 2024. And you can see here it actually rallied into 18.4 over the last 24 hours. And in particular, we get some very nice price action on the smaller time frames, breaking through the 18,200 level and closing above it. So you'll notice here, we saw that beautiful accumulation. We already liked it quite a lot. It has, it's still got problems here, there's no doubt, but it started to do the right signs and it looks like it's pulling back. And of course, the stock that we've been really floating in terms of the concept of maybe it's starting to improve has been Tencent. Now, Tencent is totally different to the HSI. It's doing way better. The pullback is less. But we must remember that across the board, China is shorted massively. So if the markets do start to push out and they get that momentum, it tends to be more fierce and more abrupt. And that's because it's similar to GameStop in some ways. People are literally getting liquidated and having to buy back into the market. We know there's a big short position here, and I doubt they're hedged properly. So it could be a very interesting one for you to watch. And of course, look at on the chart. Some interesting breakouts happening over the last couple of sessions. So what about Bitcoin? How's it looking? Well, it's kind of doing the game that we thought it would. It's coming down to this zone and it's finding a little bit of buyers, but it still hasn't shown us any type of, okay, yeah, we're ready to go yet. No huge wicks yet. I've said watch reaction here around 64. 500-ish. We've talked about this being our bottom end. It cannot really fall through this. If it falls through this, it could get really nasty and fall quite a lot indeed. But what I'd be looking for is the smaller time frames. And what you might notice is that actually, not only has it been going down a nice little trend line down here on the bottom, but actually we've got a series of really well-respected highs now. As the market's coming up, you can see it's respecting these levels and rejecting them. And it's just making a series of lower highs and lower lows. Now, if we start to see that sequence change, first up these two levels here, then that could start to get a little bit more bullish for Bitcoin. So I think this is one of the most exciting charts in the markets, and Bitcoin's actually, I think it's looking pretty cool in terms of the way that it's charting, the way that it's reacting, some decent short trades if you've been looking at them. But here is where I think the bulls really need to commit if they're going to. We haven't seen those signs yet, but we're very much focused on this chart right now. In terms of the news for the rest of the week, whenever you're looking at this type of stuff, you need to be aware, of course, of what's going on. And the central banks around the world are really the big news at the moment. So we can see here, CHF, of course, UK as well. They're coming out and going to be talking. Bunch of different speakers from the Fed are coming through to have a bit of a chat. And then, of course, we've got some Euro news as well. So it's the rest of the world this week that we'll be focused on a little bit more. And then on Friday, we have flash manufacturing PMI coming out for the US at 9:45 New York time. If you enjoyed today's video, please remember to subscribe, smash that like button, and of course, follow us at the links in the description down below. Thanks so much, guys. We'll see you in the next one. Bye for now.